Investing in the stock market can seem like navigating a vast and complex ocean. There are countless companies, each with its own unique characteristics and potential for growth. To make sense of it all, it's helpful to understand the different categories of stocks, one of the most important being US large-cap equity. Think of large-cap companies as the giant ships sailing on this vast ocean. They are well-established, often household names, and their sheer size makes them significant players in the market. But what exactly are large-cap stocks, and why should investors care about them? In this exploration of US large-cap equity, we will break down the key concepts that every investor should know. We'll use simple language and real-world examples to demystify this important segment of the market. By the end of this journey, you'll have a clearer understanding of what large-cap stocks are, why they matter, and how to think about them when making investment decisions. So let's set sail and explore the world of US large-cap equities. US large-cap equity might sound like a mouthful, but it's actually a simple concept. It refers to stocks of companies that are based in the United States and have a large market capitalization. In simpler terms, these are the big fish in the US stock market pond. They are the companies that have been around for a while, have a proven track record, and are well known to the public. Think of companies like Apple, Microsoft, or Amazon. These are all examples of US large-cap companies. Their size and influence make them a significant part of the overall market, and their performance can have a ripple effect on other stocks. Understanding what constitutes a large-cap company is the first step in understanding this important segment of the market. In the next section, we'll delve into why these large-cap stocks are so significant for investors. Why are large-cap stocks so important? Well, they are the heavyweights of the stock market. They represent a significant portion of the total value of all publicly traded companies. When these companies do well, the overall market tends to do well, and vice versa. Their performance can influence the direction of the entire market, but their importance goes beyond just their size. Large-cap stocks are often seen as more stable and less risky than smaller companies. They have a proven track record, strong brand recognition, and typically a more diversified business model. This makes them attractive to investors looking for more predictable returns and a lower risk of losing their investment. However, it's important to remember that no investment is entirely without risk, and even large-cap stocks can experience periods of volatility. In the following sections, we'll dive deeper into the specific characteristics of large-cap stocks, exploring key concepts that will help you understand their potential and risks. Section 4. Market capitalization, sizing up companies. One of the first things to understand about large-cap companies is the concept of market capitalization. It's a fancy term that simply means the total value of a company's outstanding shares of stock. To calculate market capitalization, you just multiply the company's current share price by the total number of shares outstanding. The higher the market cap, the bigger the company is considered to be. For example, if a company has 1 billion shares outstanding and each share is trading at $100, its market capitalization would be $100 billion. This is a simple but powerful metric that helps investors understand the relative size of different companies. While there's no official cutoff, companies with a market cap of $10 billion or more are generally considered large-cap stocks. Understanding market capitalization is essential for comparing companies and understanding their relative size and importance in the market. Section 5. Dividend yields, a share of the profits. Another key concept to grasp when it comes to large-cap stocks is dividend yield. Many large-cap companies are well-established and profitable, and they often choose to share some of those profits with their shareholders in the form of dividends. A dividend yield is essentially the annual dividend payment per share, expressed as a percentage of the company's current share price. For investors, it's like receiving a small piece of the company's profits on a regular basis. For example, if a company pays an annual dividend of $2 per share and its stock is trading at $50, its dividend yield would be 4%. Dividend yields can vary widely from company to company and can fluctuate over time. While not all large-cap companies pay dividends, those that do can provide investors with a steady stream of income in addition to any potential growth in the company's stock price. This can be particularly attractive to investors seeking income from their investments.